All right. Welcome, Cayenne, to week 2. I waited a few extra minutes tonight just to see if you'd be able to pop in, but I hope you're feeling okay. I know it's probably been a pretty tough week. So I was excited to see a good discussion board and a very good test that you took last week. So congratulations on both of those. You're doing a great job. So we'll look for that assignment to come in. If you get stuck on anything particular or specific, get in touch with me or get in touch with one of the tutors or the the learning help, the learning coaches that we have associated with the school. Yeah, get on the line with one of us so that we can help out if you get stuck on something. Uh, so this week we have a little bit bigger test, as you can imagine, because we mentioned last week it's a midterm. So I'll be going over a lot of questions tonight as far as topics. We'll need a little bit more time than we even had last week. I'll go through them very quickly, though, just to not take a lot of the time of the session, so that then you can go back on your time and re-review it if you need to take down a note for the different topics that'll be on the test. As far as the assignment, in format, it looks very similar to last week's assignment in that we're going to be covering 3 chapters this week, 4, 5, and 6, and you're going to have some end of chapter questions from all 3 of those chapters. So you need to look at the material, answer the questions. Like we talked about last time, we don't need APA paragraph form, but we do need complete sentences. We do need complete thoughts. I do need you to be as comprehensive as the question calls for. If the question calls for, a one sentence answer, then that's sufficient. But be careful that you're being, comprehensive about your answers. I will give you some feedback on the week 1 assignment as soon as I get it, Cayenne, so you get a feel for kind of what the expectation is there. And then, as I mentioned before, if we're not meeting that expectation, I'll always give you some feedback on what I feel like is missing and give you give you the opportunity to resubmit for additional credit if you'd like to. So don't get too stressed about it. Go ahead and turn in what you have completed, here over the next day or 2 as you get the opportunity to, and then you'll get some feedback and kind of know better going forward what to expect from those assignments, and also have the opportunity to redo parts or pieces of this assignment if you need to. Okay? So that's the assignment for this week. As far as the discussion board, I've already got you a couple comments on there. As I mentioned to you, Cayenne, it's just you and I, so you can respond to your own post if you want to do a little bit of feedback to that or further feedback to it. You can also respond to my posts, but need a couple responses in addition to that main post, of course. And last week you did a great job. So more of that is what I'm looking for, similar to what you did last week, which I thought was excellent. Okay? So this week we got a couple different topics we want to cover. The chapter 4 topic is time value of money, and really time value of money plays into so many different things when it comes to corporate finance and when it comes to financial decisions, period. The bottom line is, when we talk about time value of money, we're talking about the concept of the fact that a dollar today is worth more than a dollar a week from now, a month from now, a year from now. And it's pretty straightforward. The bottom line is there's a value over time to a dollar, right? To any amount of money. Because we should be able to get something back for time plus money. So let's think about that for a second. If I get a dollar today and I can put it in the bank and get 5%, then I'd have $1.05 in a year, and the person who only gets $1 in a year still only has $1, and so they have less, right? So that whole concept of a dollar today is worth more than $1 in a year is absolutely correct. But a dollar today is worth, if the time value of money is 5%, $1.05 in a year. Okay, does that make sense? So if somebody comes to us and says, would you rather have $1 today or $1.05 in a year? The answer is, do whatever you'd like to do, because if time value of money is 5%, if that's the rate of return that we can get on our money, then it's sixes, right? We're going to have $1.05 after a year no matter what. Okay? Now, there's a couple things that are more specific to corporate finance. Corporate finance, we're usually interested in looking at the costs and the benefits of a project, right? This is the whole NPV rule, where the highest NPV, or net present value, is the decision that we're going to make between, option A, B, and C. So if we're a financial decision maker and we've got 3 different options, A, B, and C, and A has the highest NPV or net present value, that's the decision that we should make, right? If any of the decisions have a negative NPV, we should reject any negative NPVs, right? Because that means net of the benefits, when we net out the costs associated with the project, we're going to be losing value. Now, an important concept when it comes to time value of money and net present value decision making, or NPV decision rules, the NPV decision rule is the fact that you can have a project where you're going to go, your costs are $10. That's the current value of today's cost. And let's say you're going to get $12 in 2 years from the project if you complete it. That's the benefit, right? But we got to take that benefit and we've got to back it up and put it into present value form, because that $12 benefit is in future value form, right? And we can't combine those two. We can't just take $12 minus out the 10 and say you're going to get a $2 benefit, because that's not accurate. We know that time value of money has to have an impact. And so what we have to do is we have to discount, what's called discounting, and you probably learned this in one of your original finance classes with your bachelor's degree, but we have to discount that future value back to a present value. So we have to turn FV, which is future value, into PV, which is present value, so that we can combine it with our current present value of the cost, which is a present value because that's the money we're going to have to outlay right now to do the project. And when we combine those both as present values, then we get to the NPV, or the net present value, meaning the net present value of benefits minus the net present value of costs. If that number's negative, we don't do it. If that number's zero, we still shouldn't do it. If that number's positive and we have multiple projects that are positive, we're going to pick the one, if they're mutually exclusive, that just gives us the most benefit or the most NPV. Okay? So one of the important concepts is that you might have a project that just eyeballing the project means that you're going to make money. So, for example, if I buy a house for $150,000 today and I think I can sell it in 5 years for $160,000, I might say in my mind, well, I'm going to grow by $10,000. That's great. So I should do it. Well, before I make a decision like that, I should calculate over the next 5 years what I could return on my money. So that if I were to take that $150,000 and do something different with it, could I outpace the value increase in my property value? If I can, then my NPV, or net present value, would be negative and I shouldn't do it. Okay, even though it appears on the surface to have a benefit net of its costs, when I recalculate that equation based on making that future value increase, and I back it up or discount it for time value of money or whatever interest rate or return I can get on my money, I might find out that I'm actually losing money, by making that decision instead of doing something else. So it's a great way to evaluate different options, right? That's the reason why time value of money is so important when it comes to financial decision making with businesses. With individuals, and this is just an application that I see all the time as a financial advisor, with individuals, it's important from a standpoint of making your money work for you, right? And making sure that money doesn't work against you. So money works against you when you have interest on debt, right? And money works for you when you get returns on your money. So if I put money in a CD and I get 5% return, that's my value that I get back. If I put money in a mutual fund and I average 8% over the next 9 years, I'll double my money. But if I spend money on a credit card and they're charging me 20% a year and it's compounding interest, then it's working against me, right? So time value of money can be a significant help to me when it comes to meeting future goals that I have. Time value of money can be a significant disadvantage to me if I have significant debt with high interest. Okay, so we need to be aware of time value of money, and specifically the growth or interest, depending on which side we're talking about, future growth or interest, that detracts from the value of our money because we're getting charged that interest. That's time value of money working against us, where when we save and when we invest, that's time value of money working for us on the personal side. Okay, so time value of money has important application to both you and I personally, but also as business leaders, managers, and financial decision makers. Okay, so that's kind of the background on time value of money. I'm going to skip through quite a few slides pretty fast, just so potentially we can get to some further chapters here. Hopefully we'll be able to introduce the concepts on 5 and 6. I will email you the slides, so you'll have all the slides, Cayenne, so don't worry about that. If I don't get them over to you tonight, make sure and remind me, though, if I happen to forget after we get done with class tonight. But time value of money, as I was mentioning, let's just get to some of the basics of time value of money, some of the basic calculations of time value of money, and I'm going to show them to you. We're not going to work through a lot of problems, but know that when you get to the test and probably on the assignment, you're going to have to basically know how to do not any kind of comprehensive, really, really complex time value of money problems, but some basic time value of money problems. And the easiest way that I've found to do time value of money is within Excel. If you go into Excel and you go to the top tabs, there's a tab for financial calculators under calculators. And when you go to financial calculators, one of those numbers is, or one of those calculators is future value, FV. But the more important one for calculating different time value of money problems is probably the PV calculation. So if you click on PV under financial calculators, it'll give you some inputs and help you walk you through what you need to put in order to calculate a present value. Or, like we mentioned earlier, discount a future value that you've got that's given, like a future benefit, and discount it back to a present value using that time value of money function, whatever interest rate is associated with your money. Okay? All right, so let's go over a few of these things and make sure we're on track. It talks about a lot of the calculations associated with this chapter. Like I say, we're not going to look at that very often. When we calculate time value of money, most of the time when you research this topic or try to learn about this topic initially, the easiest way to understand the concept is to do what's called timelining or develop timelines. This is not something that you need to do, when you get into a workplace environment. But this is the why of why these problems work, okay? So sometimes we jump right to a calculation and you're like, I don't know why this works, but here's the calculation for it. It's a little harder to remember those types of calculations that we have no idea what we're calculating, okay, or why it works that way. So timeline is just a way for you to visualize a cash flow issue or a future value of money issue or a time value of money issue, okay? So let's give you an example, really simplified. We got two different payments. You loan money to a friend and then they're going to pay you back $10,000 after 1 year and another $10,000 after the next year, okay? So our flow today, as you can see in the bottom left, is 0, okay? But then after a year, they're going to pay 10, and then after a year after that, they're going to pay another 10. So you're going to get $20,000 over 2 years, okay? So that's what a timeline looks like. It's just basically charting cash flows, okay? And obviously that just lets us see what's going on. But more importantly, we're able to look at inflows and outflows, right? And we're also able to start to do some basic calculations. So here's a timeline based on inflows and outflows. You've got that outflow of 10,000, then you've got inflows of 6,000 two different times. So this is something that your outflow is $10,000, but if you put $10,000 in, you're going to get two payments of 6 for a total of $12,000 back, okay? Which, might be pretty good depending on how high the time value of money is. All right, so here's the problem. Here's what the timeline would look like. You can review this, but setting up your own timelines does make sense. Rules of time travel. Cute. They're calling it time travel. Anyway, rules of timelines, rules of time value of money, okay? Some basic rules that you have to have. We talked about how $1 today isn't worth $1 in the future, so that's first rule. Okay, you've got to have more later in order for them to be equivalent. And it just depends on what this interest rate is. So in this particular problem, it tells you that you should be able to expect a 10% return, but every problem can be different, and every era and every business might be different too. So for example, right now interest rates are very low. It's very difficult to get high interest returns, and so the opportunity cost or time value of money for these time value problems might be very, very low. For example, for me personally, if I put my money in the bank right now, I might get 0.2% on my savings, which is really, really low. So 1/5% every year will be credited to my account based on how low interest rates are right now in savings. In a CD, for example, for 5 years, I might be able to get 1.5 or 2%, okay, which is still really low. But all I'm saying is that might be my opportunity cost or time value of money option for my money right now. But 10 years ago, it might have been 5% on a 5-year CD instead of 1.5 or 2, right? So it depends on where interest rates are at. It also depends what matter of business I'm in, because a lot of businesses have the opportunity or ability to reinvest in their own business, right? To research and develop, or to, just build more product. manufacture more product, inventory more product, build more buildings, and all these things, a dollar in has a very specific rate of return. It might be much higher than some other kind of new project or new product, or a bank account, obviously. So if I'm a business like Walmart, for example, my money, the best way for me to grow my money might be to build the next store, right? Because every dollar I put into that store probably has a pretty high return on it. If I just take all my cash and I never build no more stores, and I just put all my money in the bank, my money will grow at a much slower pace, obviously, than if I'm growing and building more stores. So, I mean, that's oversimplified, but that really is what it comes down to. Financial analysts for businesses sit around and crunch a lot of numbers to try to determine whether or not it's better for them to do different growth opportunities, different research and development opportunities, different inventory and manufacturing opportunities, or just to invest the money into short or long-term investments that are unrelated to their business. But when they make those decisions, they've carefully gone through their alternatives, right? And they're putting some kind of projection number on the time value of money as well, some kind of percentage associated with how much they think they could return on their money based on making the decision they do. So then we've got a situation called compounding that happens when it comes to time value of money. So here's a great timeline that shows us what happens when something compounds. This illustration right here, this timeline that we're looking at now, is illustrating a 10% return that's compounding. And what that means is the first year we get $100 of credit, and the second year, though, we get $110 of credit. Why did it go up when the interest rate stayed the same? Because the interest was compounding. So the $100 paid into the account, and then that next year is 10% on $110 instead of, or excuse me, $1,100 instead of $1,000. So that's why compounding interest rate works. In the very short term, compounding interest doesn't look too impressive. In the long term, compounding interest, for example, with investments that go out 20 or 30 years, is absolutely exponential and substantial. Okay. So the difference between just getting a crediting rate or a simple interest rate on your investments, for example, if I put my money in the bank and I have $5,000 and they're willing to pay me $100 a year on it at 2%, that's fine. I'll get $100 a year forever, right? And that sounds decent. But if I can get 5% compounding, okay, that means every approximately 16, 17 years, I'm going to double my money in the account. Instead of every when at 5%, it would be 20 years, right? That first time before it doubled, if I was just getting simple interest. So that first 20, not a huge difference, but then when you go from there, it just gets more and more substantial as it compounds. So compounding interest is the reason that interest compounds is because of the time value of money, and the higher the interest rate associated with it, the faster compounding interest has a significant impact on your balance. But compounding interest works for you when it comes to investments. It can also work against you, obviously, when interest compounds, like, for example, on a credit card. Credit cards obviously have compounding interest. And one of the reasons that if you pay the minimum credit card payment, that sometimes you never feel like you're making progress on paying down your debts, is because you really are never making progress on paying down your debts. The minimum payment is designed on some credit cards, not all, but on some credit cards, to basically just have you continue to pay interest forever so that they can collect profit, right? So that they can collect interest payments from you. And unless you start paying more than the minimum payment, some of the payoff periods are like 20, 30, 40 years. That's how long it would take you to pay off your credit cards if you're only making a minimum payment. Okay? So compounding interest and time value of money is one of the reasons why we got to pay down our credit cards a little faster than minimum payments, because it just takes so long because of compounding interest if we don't. So here graphically is a great graph, that a chart that shows you the power of compounding interest. Okay, so it goes out 20 years, right? And the green is non-compounding interest, so what we call simple interest. Okay, the blue represents compounding interest, and you can see early on in years 1, 2, 3, the difference between compounding interest and simple interest is not that significant. But when you get out to 20 years, you can see the difference between simple interest and compounding interest is significant. It's double, right? It's more than double. So compounding interest makes a huge difference if you're able to reinvest, dollars and then get paid additional interest on top of your interest. That makes your money work for you. There's a book, a pretty popular book called The Millionaire Next Door by Napoleon Hill. It's an old book. It's kind of like after the same ilk as Think and Grow Rich, but Napoleon Hill in uh, the Millionaire Next Door, or basically just talks about the concept of making your money a slave for you in order to work, right? And it's not, slaves. I mean, that's kind of a weird term, but the whole idea is to make your money work for you, right? Don't let it be idle. Don't let it be stagnant. Don't let it be static and just get simple interest, or don't let it get nothing. I mean, don't let it just sit. You've got to have it working for you. When it comes to companies, business leaders, managers, and executives of businesses, they always feel the pressure to make their money work for them and to be growing, their business. But sometimes you and I personally have a hard time making sure that we treat our own personal finances the same way and make our money work for us, right? Don't just go out and let other people benefit from us, right? Okay, that's what happens when we're significantly in debt. Somebody else is making money off ours, right? Well, if we can get to the flip side of that, where our investments are making us money, our rental properties making us money, where our money is actually working for us, obviously that's the ideal situation. And that's the ideal way to make time value of money work for you instead of against you. Another example of compounding interest talks you through how that works and how significant that can become. The rule of 72 is probably the most common time value of money problem that we talk about. The rule of 72 just states whatever two numbers, when you times them together, equals 72, that will give you your years and interest to double. So let me describe it in a different way, because that was kind of confusing. So if I have 8 years to invest and I can get a 9% interest rate, I'll double my money in those 8 years, because the product of those two, of timesing 8 times 9, multiplying those two, is 72, right? So you can do the flip way. If I've got 9 years to invest, then I only need an 8% interest rate to double my money. But if I have 10 years to invest, then I only need a 7.2% interest rate to double my money. So whatever the product is, when multiplying two different numbers, one of those numbers, X, let's just call it X, needs to always be the number of years, and Y always needs to be the interest rate that you're going to be able to get. The product of those two, if they equal 72, then the formula is true. So another example would be, if I'm getting a 2% interest rate at the bank, how many years would it take for me to double my money? Well, that would be 2 times Y equals 72. That's how you would set that problem up. Okay. So what is 2 times Y equals 72? Well, if you divide both sides by 2, right, then you get your answer. So Y equals 36 years. It takes 36 years. But you could have just done it in your head, right? 2 times 36 equals 72. So it takes 36 years at 2% to double your money. Even a more simple problem, how long would it take you to double your money if you're getting 1%? If you're getting a 1% return, how long would it take you to double your money? Well, what times 1 equals 72? Well, the answer is 72. So how many years does it take at 1%? It takes you 72 years at 1% to double your money. If I can get 12%, it only takes 6 years to double my money, because 6 times 12 is 72. Okay, so it's a little bit oversimplified, but it's a very easy way to calculate how fast you can double your money. And it's very impactful when it comes to me helping people with their investments, right? Some people will say, I'm not really aggressive. I don't want to do the market. I feel like I might lose my money. It seems really unsafe and risky. And I say, well, the stock market over the last 80 years is the only place to get an 8% return. And at different times, it's even gotten as high as 12%, for different 10 or 20-year periods. If you leave your money in the bank, you will never get more than 1% at this point. Now, interest rates might go up in the future, but right now, you're not going to get more than 1% of interest in the bank. So it's going to take you 72 years or more to double your money in the bank. And in the market, even though it's going to be a roller coaster, yes, it's going to go up and down. Yes, it has some risk. But if you leave it in long enough, and over a 10-year period of time, it does what it's done in the past and averages an 8 or 9% return, you'll double your money every 8 or 9 years instead of every 72 years like the market. Okay, so it can be pretty impactful and inspiring when it comes to, you know, doing what is probably the right thing for most of us, which is to assume some risk. It doesn't mean we need to all be risky and take on a lot of risk, but for example, if we've got an account that we're looking to invest for the next 30 years and we're not going to touch it because it's for our retirement, we probably should take on some risk in order to get some return beyond what banks are giving us at, basically nothing, is what we're getting on our interest within a bank account. Okay. And the same is true, obviously, for businesses. They've got to look at their cash and they got to make sure that they're using their cash in a way that grows their money the best way possible. And businesses all have to take risk, right, in order to do that. And the same is true for you and I as individuals. We don't have to be crazy. We don't have to be, careless. We want to be prudent about how we make these decisions and analyze them and maybe get help if needed. But in the end, we need our money to grow so that we can increase our money over time and not lose value to inflation. Because when it comes to investing, one of the things working against us as far as time value of money is concerned is we've got to grow our money faster than inflation, or we're losing value every year, because inflation erodes the value of our money, erodes our ability to buy anything, buy products and services, right? So if bread was $1 50 years ago and now it's $3 a loaf on average, our dollar is worth about a third of what it was, 20, 30, 40 years ago. Well, if I didn't grow my money by at least that same rate, then I've lost value. I have less of what's called purchasing power because of inflation. All right, enough about timelines. I'm running out of time here because my timeline has almost ended tonight. Talks to you a lot in these slides about how to use a financial calculator to calculate these different these different formulas. You could Google financial calculator. You don't necessarily need to have one of these calculators, and just practice these, because if you Google financial calculator, bring it right up. One that you can just input the information just like how it tells you to on these slides. But like I say, my personal preference is actually using Excel. I find that a lot of times when I'm doing math work or different charting and things like that for business or for finance, I'm going to be in Excel anyway, so it's just really easy to use Excel to do it. Okay. Cost, benefits, net present value. We talked about NPV. CFJ is just cash flow. So those are different cash flows. Perpetuities, that's when you have a cash flow that's going to go on forever. So, and there's different things that can happen like that. For example, I might have a trust, a big trust fund that pays out $10,000 a year for the health and benefit of all the grandchildren in the family forever, okay, as long as they're alive. So we don't know how long that's going to be, but it's going to last until we're gone. So it's basically an annuity into what we call perpetuity, which perpetuity means that it'll last forever, or at least as long as we're around. And it's even more similar to calculate a perpetuity annuity as far as the interest rate associated with it than it is any other kind of problem. And it gives you some examples on how to do that here. Uses the terminology annuity. I will just say, for purposes of time value of money and finance, you'll want to differentiate what you may have heard about annuities as far as a product that you can buy from an agent or a life insurance guy usually is selling annuities. That's not what we're referring to here, although there are some similarities between the annuity that somebody's trying to sell you and what we're talking about. Annuities here is a financial term, okay? When we mention the word annuity, we're just talking about a payment over time. Okay, that's all we're talking about. We're not talking about a specific product. We're not talking about MetLife annuities or Nationwide annuities, some financial product that you can go buy at the bank. We're talking about the concept of a payment over time. Okay, so when somebody wins $1 million in the lottery, they usually have an option to take $750,000 up front or take $1 million over 20 years. If they decided to take the $1 million or full payout over 20 years, they would be taking what's called an annuity, right? Because it's a payment over time. That's what an annuity is. Okay, at its core, as far as a financial definition. Just as an aside, when we talk about time value of money, the lottery is a great example of time value of money, because whatever that number is that they say you're going to win, you usually have the opportunity to win that over time in the form of an annuity over 10 or 20 or 30 years, or your lifetime anyway. Or you can take what I consider a greatly reduced benefit to take a lump sum up front. Okay, you pay more taxes when you take a lump sum up front. You have more risk of going broke a year or two later, which statistically most lottery winners are broke within a couple years. They're usually bankrupt within a year or two of winning. And so that annuity payment, is something that people look at and say, well, I don't want to, I don't want $50,000 a month. I'd rather have, $750,000 today. But if they did the math on that, it'd be much better for them to take the annuity payment. That was a bad example, but when you look at the choice between the annuity payment and the lump sum, the annuity payment is almost always in their best interest, but they almost never take it. They almost always take the upfront, take a significant discount on it because they just want their money soon, right? And you can understand that. People are excited and they just want to take it right now. But the tax consequences, like I mentioned earlier, and the fact that you're getting so much less might not be worth it. It might be much better to take an annuity over time. Okay, so now we've talked about the lottery, so we're in good. Oh, and just like that, we've got a slide that talks about the textbook problem of the lottery. So this example tells you that you won 30 million. You can take $1 million a year, or you can take $15 million today. Saying which one should you do? Okay, so you can go through that problem. Tells you how to do it on the calculator. And there you go. Here's another example. Okay, so you've got some different examples that you can review. And that's all I want to cover on annuities. So let's look at Chapter 5 just briefly. We're not going to be able to get to Chapter 6 tonight. But let's talk real quick about interest rates. If I can get this one to go for us, we'll spend a few minutes here. Okay, you should be seeing Chapter 5, interest rates. So let's go through and talk about interest rates, just real basically, give you a quick heads up. And then, like I say, we need to use the rest of the time to cover topics for the test this week. And yeah, go over those topics. Excuse me, I need a little bit of drink. Okay, so one of the key concepts when it comes to interest rates is what your effective annual rate is, or EAR. And effective annual rate is one of these concepts that's kind of a hard thing to understand, but it has to do with the concept of compounding interest and time value of money. That's why Chapter 4 covers the concept of time value of money, to get you comfortable with this idea that there can be an underlying interest rate that compounds either up or down, either for you or against you when it comes to interest. And when you get to interest rates, for example, on a loan, you may have an interest rate that's a stated rate, okay, and then you have an effective rate. So what's the difference between a stated rate and effective rate? Well, your stated rate might be per year, but you're compounding every month or every day or every 3 months, quarterly, okay? So what do I mean by that? Well, the stated rate could say this is a 12% interest rate on your money, okay? 12% could be, though, the annual percentage rate. And the EAR, the effective annual rate, okay, might be a little bit higher if it in fact, it will be higher if it compounds any more than once a year. If it compounds once a year, the annual rate and the effective annual rate will be equal. But if it compounds any more than once a year, so if it compounds quarterly, monthly, daily, because you've got daily compounding interest rates, that one obviously will be the highest because it compounds more. So the more an interest rate compounds, the higher the interest rate, the effective annual rate is. So it's a little bit of a misnomer when a bank will say you get a 12% interest rate on this loan, but the effective annual rate is 12.9, and you're like, well, what is it then? Well, what it really is 12.9, right? Because that's your effective annual rate because it's compounding more than once a year, and that's how much you're really getting charged in the end. Okay, so make sure you're careful to always when you're looking at bank rates, different rates, they have to by law post both. If they're going to post just a simple rate, they've got to post the effective annual rate as well. But a lot of people don't know what the difference between the two, and so they don't even pay attention. But you want to be always paying attention to what's called the effective annual yield, effective percentage yield, effective annual yield, or effective annual rate, EAR, EAY. The effective rate is much more important because that's the bottom line. That's really what you're going to be paying. The annual percentage rate, or just the rate, right, that they publish, may not always be exactly what you're going to be paying. Okay. So you can adjust it. You can adjust rates based on your time period. Shows you an example of how to do that. Annual percentage rate, this is the simple one that I was talking about. This is a simple interest one. And you can't use an APR as a discount rate because it doesn't account for time value of money. You have to use an EAR, or an effective annual rate. So how do you go from an annual percentage rate, if that's all you're given, to an EAR? Well, here's the calculation right here. Okay, and then it'll give you an example of how to do that. But as I just mentioned, if you've got an annual percentage rate and an effective annual rate, if it compounds annually, they're going to be the same. Okay, so you can see by this chart, if it compounds annual, the effective annual rate of a 6% APR is 6%. But it's 6.18 if it compounds daily. Okay, if the interest compounds daily. So you're paying almost 20 basis points more per year if it compounds daily than you would have been if it only compounds once a year. And you might say, well, no big deal. You know, the difference between 6% and 6.2, it's no big deal. But when you're talking about you as a business owner and millions of dollars, it's a significant deal. Okay, you want 20 basis points could be the difference in you getting fired in a couple years for not understanding this concept, or you keeping your job, because that could be a substantial cost to the business, or difference in cost, if you weren't aware that you needed to convert an annual percentage rate to an EAR, okay, an effective annual rate. The other thing I will say is that when it comes to like a mortgage, for example, if an effective annual rate or an annual percentage rate is 6%, but you're paying 6.18 because it's a daily compounding, the difference in mortgage payments, if you were to look at one versus the other, 6 versus 6.18 on, say, $250,000 loan or $300,000 home loan, would be substantial again. Okay, so it is relevant. I know these numbers don't sound huge, don't sound really big, but it's very relevant, and it's very important to understand the difference between something that's compounding annually, as far as the interest is concerned, has a simple interest rate once per year, and something that compounds daily, monthly, or quarterly. Okay, and frankly, it just, you know, the more I talk about this, the more I just think, you know, banks are kind of gimmicky about this. Why don't we just scrap the annual percentage rate, unless it's a compounding annually, and just make them only publish. So don't publish even both, but only publish what the actual annual percentage yield is, or effective annual rate is, because that's more relevant, right? That's in the end what we're going to actually be paying. But that's not how they do it. So you need to be aware of both, and you need to be aware of both in business, because terms, you know, from a standpoint of business terms, like for example, accounts payable, a lot of times we'll have different terms. You may remember like 130 net 60. Remember that term from finance? Those were receivables terms, where a company would say, okay, if you pay us within 30 days, we'll give you a 1% discount. That's what that 130 means. And then the net 60 means that you have to pay us within 60 days. It's due within 60 days, or you're going to get a penalty. Well, there are ways using the same effective annual rate calculation to calculate how much it's worth on a percentage basis to get that discount, versus wait till the end of 60 days. Because as a business owner, paying payables, right, paying our accounts payable, if I'm not going to take the credit, if I'm not going to take the 1% bonus, I should technically wait until the end of the 60 days and pay it right at the 60th day, so I don't get the penalty, but so that I use all that free time of zero interest against me that I possibly can, if I'm not going to take that bonus rate. Okay, if I'm not going to take that 1% bonus anyway. So the worst thing you could do is pay on day 31, right? You didn't get the 1% bonus, but you also paid early, which means you have your money for less time, which means that you're not being prudent from a business strategy or business planning standpoint, using the concept of time value of money. Okay, so that's just a quick example of how that works with accounts payable. Depending on which side of the fence you're on, it's either receivables or payables, right? If I'm the vendor, I want my clients to pay as fast as I can. That's why I give them a bonus for paying early. If I'm the folks on the other side, you know, and I'm the one with the payables, because they're my vendor, I'm the customer, I want to pay as late as I possibly can to keep my own money as long as I can and make money off of it. But if I can get a bonus, I need to calculate my effective annual rate and see if it's in my best interest to pay early. Okay, so that's a lot as far as interest is concerned. Let me just give you a little bit on the next chapter, since we're going. I know I just zipped through way too much material on that one in hardly any time. But one of the concepts that goes right along with what we've been talking about is bond valuation. And you might say, what the heck are you talking about? We just talked about time value of money, which had an interest rate associated with it. And then we talked about interest rates. That all makes sense. Why would bonds have anything to do with interest rates? And the answer is, bonds have everything to do with interest rates. The most important thing to the valuation of a bond Okay, and this could be a bond mutual fund, it could be a municipal bond, it could be a treasury bond, it could be a savings bond, it could be a T-bill, it could be a T-note. I mean, there are all kinds of different bonds out there. The bond market is substantially bigger, exponentially bigger than the stock market. So you and I hear a lot more about the stock market, but reality is the bond market is a much, much bigger market as far as capital markets are concerned. Trillions of dollars. And it's where businesses go, the bond market is, to raise capital, right? And the way they understand how they're going to value their bonds when they're raising capital, or the way that you and I understand bonds when we're investing in bonds, is completely dependent on interest rates. Okay, so if we understand the basics of time value of money or the basics of interest rates, bonds and the reason that they price the way they do is going to make a lot of sense, because all a bond is a promise from one entity to another. Okay, in the case of me being an investor, it's a promise from, some company. Let's say it's Wells Fargo. They're promising me on an 8% bond that they're going to pay me 8% per year, and then the end of 20 years they're going to pay me back my money. So I put $1,000 in, I get $80 a year until the end of the bond term at 20 years, and they give me my $1,000 back. Now, you might say, well, I didn't hear anything about interest. Why is interest so important? Interest is so important because once I have that bond, if interest rates go up, the value of my bond goes down. If interest rates go down, then the value of my bond goes up. And why does that happen? Because if I try to go sell my bond and interest rates go up, people are going to be less inclined to buy my bond at 8% if interest rates have gone up to 10. Right? And so I'm going to have to discount my bond in order to sell it. But if interest rates go down to 6% and I've got an 8% bond, then my bond becomes more valuable, right? More people want to buy it from me because getting 8% when all the other interest rates are at 6 is really lucrative, right? So they're going to have to pay me what's called a premium to get my bond. So interest rates absolutely dictate the value of bonds. And one of the things that's a little bit worrisome at this point in the marketplace, okay, in the world, is that interest rates are at all-time lows. And if we know that interest rates going up is bad for bonds, it's likely that at some point, I don't know how soon, but at some point over the next 10, 20, 30 years, could be next year. But at some point over the next upcoming time, bonds are going to have to go down in value because interest rates are going to have to go back up, okay, because they're at all-time lows. And really for the last 30 years, bonds have done nothing but go up in value because interest rates have done nothing really since the 80s but go down. So the trajectory of bonds over the last 30 years has been great, and the trajectory of interest rates has been down because they go in opposite directions, right? Now over the next 5, 10, 30 years, it could be exactly the opposite. Bond values might consistently go down because interest rates might consistently either stay stable or go up. So just something to keep in mind about bonds. If you remember nothing else tonight, just be careful when it comes to bond investing. Our parents and grandparents are heavily into bonds because that's the safest thing to invest in. It's much safer than the stock market. However, the risk reward on bonds, if you're heavy into bonds right now, could be very poor. If interest rates were to start to go back up, your bonds are going to go down in value, and they might go down in value more than even what you get paid as far as the interest rate on them, and that would be a bad deal, right? We'd be losing money instead of making it on our bonds. So just something to keep in mind, something to make sure and be careful about when it comes to bond investing. Most of us have mutual funds that have bonds in them within a 401k, and most of us, if we're getting conservative and about to retire, will have a lot of bonds that we invest in. And there are some bonds that are a little better than others as far as ones that are safer if interest rates were to go up. And so that's where an advisor or some good research can help you make sure that you've got the bonds that aren't going to hurt you as much going forward. Okay, we didn't even go to any slides, but that's bonds, and that's why value in bonds has so much to do with interest rates, because interest rates are what drive whether or not a bond is a premium, sells at a premium for more than what it was bought for, or whether or not it sells at a discount for less than what it was bought for. Interest rates going up drives bond prices down. Interest rates going down drives bond prices up. If you just keep those things in mind, those are significant life lessons that can help you on your personal investing side. Not to mention, understanding how business and finance works when you start talking about financing companies with bonds, which is very common as well. All right, but that's enough of that. I'm going to send you the slides. We need to get to the test. We've got about 15 minutes left tonight, so I've got about 15 minutes to go through about 50 problems. I'm going to go fairly quickly. If you have any concerns or problems, Cayenne, as you go through this or reviewing it later, and hopefully you do to get the different topics that you'll need to know from these 3 chapters for the test. But as you're going through it, if you have any questions or concerns, just send me a quick email if you don't understand something that's on it. There may be some repeat questions from week one. Keep in mind that the week one test, that material is fair game for a midterm. The midterm's worth twice as much. It's worth 100 points, where in week one it was only worth 50. Like I said, Cayenne, you smoked it. You did great. Great job on that one. This one's a little longer, a little harder, and it's more comprehensive. It covers more chapters. So I would just suggest, once again, that you take notes on the different topics that'll be on there. Then as you read through, make sure you make a note on those topics to spend a little bit extra time on them so that you feel comfortable before you get to the test. Because as you experienced on the test in week one, even though you did really well, there are different problems sometimes that you get to, and you're like, well, I know the topic, but I don't really know, what the answer is, because I don't really understand the topic as much as, I would like to. Okay. All right. So let's start with number one. Number one on the test, you just need to know the concept of the evaluation principle. Now, this is a repeat. I don't know that it's a repeat question, but it's a repeat concept from last week. So you need to understand why the valuation principle is important, and what the valuation principle is. It's a true-false question. By the way, all the problems on the test this week are either true-false or multiple choice, just as a heads up. Similar format to week one, just more problems. Number two on the test is a repeat question. I'm not going to go over it. It's a repeat question from last week. Number three on the test is a repeat question. 4 is a repeat question. 5 is a repeat question. 6 is a repeat question. 7 is a repeat question. 8 is a repeat question. 9 is a repeat question. Okay. 10 on the test, I'm not sure if it's a repeat question. I just can't remember offhand. This one has to do with who, and it goes back to, I think, chapter 1, if I'm not mistaken, on entity types. And a lot of these questions that are repeat questions are entity type questions, like difference between sole proprietorship and partnership and corporation, right? And we should know that material fairly well from last week, but just refresh yourself on the differences and pros and cons of each. But when we talk about an entity that can have partners that don't manage, we're talking about limited partners, right? You have managing partners and limited partners. Limited partners don't manage day-to-day operations. They might just be people who brought money, right, to help fund the business. Managing members, okay, or managing partners are the ones that actually help manage day-to-day activities. Limited partners, not so much. Okay? And limited partners a lot of times will have limited liability because of their limited role in the business. But that's, just make sure you understand that limited partnership. Who are those people and what are they doing? Are they managing day-to-day operations? The answer is usually no. Advantages, disadvantages of sole proprietorships. I think that's a repeat question. That's number 11. Number 12. Different statements. I think that's from chapter 2. That's a repeat question. Again, you need to know the different statements. Same with chapter number 13. Another statement issue. Number 14 is a question about something that would show up on a balance sheet, and whether or not it's an asset or a liability, and whether or not it's a long-term asset or long-term liability. So if you know the difference between long-term assets and long-term liabilities, and the difference between short-term assets and short-term liabilities, or what we refer to as current, then you'll be fine. Just make sure you read through and refresh on what types of things on a balance sheet might be referred to as a long-term or short-term, or a long-term or a current asset or liability. Same for number 15. That's another question about current assets and liabilities versus long-term assets and liabilities. Number 16 on the test is about balance sheets, where on a balance sheet the assets and liabilities are. I'll give you a hint. Assets are always on one side and liabilities are always on the other. Okay, so just refresh on which is which assets or liabilities goes on which side, and you'll be good to go on number 16. Number 17 is a repeat question from last week. I remember us talking about gross profit. How do you calculate gross profit? Number 18 on the test is another repeat. It's asking about what a competitive market is. So what is a competitive market? Make sure we understand that. Make sure you understand what the definition of present value is, or PV. Make sure you understand what the definition and how NPV works, net present value. We talked about that quite a bit tonight, but make sure you refresh on what net present value is. Okay, so on 21, we're finally to our timelines in the first chapter we talked about tonight, which is chapter 4. You're going to want to understand, for purposes of a timeline between inflows and outflows, what the color assigned with them, whether or not we use colors or whether or not we use negative signs on timelines. Okay, And you can see it from the book. You can also see it from the slides tonight. Did the slides have colors, to coordinate negative or positive, or did they just have a positive number without a negative sign, and then if it was a negative sign, put a negative sign in front of it? And this is just a simple true-false question. They just want to know whether or not you use color to dictate that, or whether or not you use a negative sign when dictating that something's negative. So you'll want to know what the book has to say about that, not necessarily searching online, and getting an answer. It might not be right. Let's see, dollar. Okay, so we talked about how $1 today is worth more than $1 in the future. That'll get the number 22 question right. 23 questions about the rule of 72. We talked about that a little bit. Number 24 is net present value. Again, we want to learn about present value and what present value is. You'll get number 24 right on that one. Number 25 is a PV problem. Excuse me, it's a future value problem. It gives you PV, which is present value, and it asks you to calculate future value. So you either need to be able to practice and get this down to where you can do it on your calculator, or get it down to where you can do it on Excel and be able to calculate a future value problem or a present value problem, because number 25 is a future value problem, number 26 is a present value problem. One of them you're converting one direction, and the other you're converting the other direction. Okay. Number 27 is a rule of 72 problem. You just got to understand basics of how to do a rule of 72 problem. Number 28 is back to $1 today is worth more than $1 in the future. Okay, make sure you know that for number 28. Number 29, basic time value of money issues. Okay. Basic time value of money issues, just make sure you understand that the present value and a compounding value are different, right? I mean, we always want to present value whatever the number is, but we might have, for example, when we talked about NPV calculations, how we have a cost and a benefit. Benefit usually is a future value. Cost is usually a present value. And that present value of cost doesn't need to be compounded anyway. It's not a compounded number at all. It's the cost is the present value. So we don't have to convert it at all. What we have to convert is that future value. We have to convert it back to a present value, discount it in order to have like terms so that we can minus one from the other and determine what our net present value is. Okay. Number 30 is a present value question, true, false. Number 31 is okay. So number 31, you just want to understand how a loan works. Okay. It's under time value of money. You just want to understand how a loan works. Excuse me, it's not under time value of money. It's under interest rates. So chapter 5. If you understand what a loan is and what it really means to have a loan, like a mortgage loan or a car loan or a credit card debt, that's basically you just, promising to pay back interest over time for the right to use money now, right? So just understand what the definition of a loan or interest is, and you'll be in good shape. Number 32 is kind of it's pretty self-explanatory. It's pretty direct, but the whole concept is the more demand there is for saving in a certain way, the lower the interest rates are going to be. Okay, if there's low demand for saving, then they're going to have to up the interest rates to encourage people to save more. So I mentioned earlier that interest rates are at all-time lows. That means that there's high demand for savings, and the banks don't have to give us high interest because we're willing to save either way. As soon as we were all doing something different, nobody was saving at the banks would have to increase their interest rates in order to get us to save. Okay, so if there's more demand for if there's more demand for savings, interest rates can go down. If there's less demand for savings, then interest rates will go up to increase the demand. Make sure you understand what the APR is. We talked about the difference between the APR and the EAR. Just make sure you understand what the difference between the effective annual rate and annual percentage rate are. And just you don't need to dig real deep, but just make sure you know the basic differences between those two, and you'll be in good shape for number 33 and 34. Number 35 is an APR conversion problem. You got to convert APR to effective annual rate. There's 1, 2, 3, 4, 5. Got 5 problems up till 39 that are all conversions APR to effective annual rate. Okay, so you need to have a pretty good idea of how to calculate those. As I mentioned before, you can use a calculator, you can use Excel, but just make sure you've gone through the slides and understand how you can convert to an effective annual rate before you get to the test, because there are 5 problems. 35, excuse me, 34 is not. 34 is just APR information, basic definition. But 35, 36, 37, 38, and 39 on the test are all time value of money and APR problems. Okay. You'll want to understand what the net present value rule is. What is the net present value rule? What are you doing with the net present value rule? Okay. That's also for 41. What's the NPV rule? Number 42 is asking you to calculate an NPV. So understand how you, okay, so first step, right, is to take costs. And second step is to, excuse me, first step is to take the benefits and discount them to present value. Then once you've discounted on present value, take the present value of the benefits minus the present value of the costs, and that gives you the net present value. If the net present value is, like I say, above zero, then it's a good project. If it's below zero, it's a negative project. You shouldn't do it. Keep that in mind. Number 43, you just want to know the concept or the difference between IRR, or internal rate of return, and net present value. A lot of businesses will evaluate both IRR and NPV, but in most cases, NPV is going to be a more significant determination in whether or not you do a project or not. And if they conflict, for example, if your IRR is positive but your NPV is negative, most people still won't do the project because they trust the NPV value more than they trust the IRR value. Okay, so just you want to know the basics between NPV and IRR, what they are, what they're used for. You want to understand what the book says about the payback rule. What is the payback rule? You want to understand, once again, how IRR and NPV are related and also how they can be different. So just the basics of what the book says on that. Number 46, you want to be able to calculate a payback period, basically an annuity problem. And number 47, we've got some different cash flow problems. You're calculating the NPV, and you want to calculate which one would be the right decision. So once again, NPV. Number 48 is an IRR and NPV problem where it lists a bunch of different things and says what's false or what's true. So you want to know the basics of NPV and IRR, what the book has to say about it. Number 49 is another payback rule question, so just make sure you understand what the payback rule is. And number 50 is the IRR, just another one that is trying to make sure that we understand the ins and outs of what IRR is, the internal rate of return, what it's good for, what it's not so good for, what it is compared to NPV, what it's sensitive to, which is different than what NPV is sensitive to. So anyway, just make sure you feel really good about the difference between NPV and IRR before you get to the test. Okay, so that's what you're going to need to know for the test. If you have any questions as you review this later or re-review it, just let me know. I just wish you the best of luck this week, Cayenne. I hope you're feeling okay and things are going okay. If you get hung up on anything, let me know, but I'll look for your assignment coming in, and I'll look for this week's work, and just have a great week. Have a good night.